What's up, traders? Let's speak about the WM strategy. So in this session we will be speaking about the WM strategy, and let's first start by defining which are the rules of the WM strategy. Now, first of all, you need to have either a W or an M. So rule number one, let's write them down: W, or let's put a big W, or M formation. Very simple. Now, what is the second rule? The second rule is that there needs to be no daily support or resistance, so previous support to resistance. In other words, we don't need to have any kind of daily structure. So no daily structure, because if you have daily structure, what basically happens is that you are in the situation of the ICI strategy. So I don't know if you already watched it or you already learned it or not, but anyway, if you have no daily structure, if you have daily structure, then it means that you can apply the ICI strategy. So obviously you cannot apply the WM strategy because it makes no sense, because basically your take profit level is going to have to face daily structure. So there needs to be no daily structure, and I will explain that further later. And another rule is that obviously the 4-hour entry rules need to be satisfied. So these are the rules of the strategy. Now, what I mean by 4-hour entry rules need to be satisfied, you will understand them very soon. Anyway, it's the exact same concept as we already spoke about before. The patterns that we will use for entry plus the indicators that I will now teach you how to use are this, and obviously the strong numbers are exactly what we use for our entries. But anyway, that is something you will see just now. So these are basically the rules of the strategy. On the weekly, because now we will be speaking about W and M formations on the weekly, and then I will be making another session for W and M formations on the daily time frame. This is just for the weekly because a little bit changes, because obviously if you're speaking about W and M formations on the weekly time frame, there is a reason for which I said that we need to have no daily structure. But if we're looking for daily and M formations, that obviously these rules we won't have it, because we are already on the daily time frame. So obviously these are the rules for the weekly time frame. So let's go and let's find some M and W formations, and let's see how we can use these patterns without having any daily structure to take our entry on the 4-hour time frame and obviously make some percentage on our account. So I've here found for you guys already some WM formations just before I started this video, so we already had, we could go faster. So I don't want to waste too much time on finding the patterns, because that is the very easy part. So here we have very simply a nice M formation, and we're expecting a push to the neckline. Again, here we have another M formation, and we're expecting a push to the neckline. This M formation becomes W formation because we have down, up, and you're expecting a push to the neckline. Again, you have down, up, and you're expecting a push to the neckline. That never happened, but still the pattern was there, so we obviously were there to take our entry. We have up, down, obviously M formation expecting a push to the neckline. Again, down, up, expecting a push to the neckline, which never really happened. The market kept pushing to the upside. So this will be enough examples to clarify the concept, and then in further sessions we will be making more and more of this videos. But this is just the important thing about these sessions, about the sessions of the course, is that they need to lay the foundations on what you're supposed to expect from the market. So basically, what are the rules of the strategy? Because in this way, after you watch this foundations episodes, basically giving you the foundation of the strategies, then you can watch the daily market breakdowns that I send in the groups, so that you can basically you understand everything that I say, and you understand everything that we are expecting from the market, because that is the point of a lifetime mentorship program. You're getting updates each and every day, so you're basically learning every day, but you need to have the foundations to understand what I'm saying in the videos when I'm speaking, when I'm basically making the breakdowns for you guys. You need to know what are our rules of engagement, so you can obviously learn the strategy and backtest and apply them. Now, we will also be speaking about how you're supposed to backtest the strategy. Now, very simply, you're supposed to, the easy way is just to take vertical lines and put them on the push to the downside, on the weekly candles of the push to the downside. By doing this, what happens is that you're getting the beginning and the end of these weeks. So basically weeks. So basically this is the first week, second week, third week, you're getting the beginning and the end of these weeks. So let's keep going until the market hits the neckline. So at this point, you have all of the move from which the market, you were looking for longs here, looking for longs here, looking for longs here. We will now show you how you were looking for longs on the 4-hour time frame. So let's use the reply tool. And from this moment, obviously you were looking for longs because you had your M formation. So the first of your rules was satisfied, M or W formation. Yes, we have a nice M formation, very clear to see it. We have up, down, up, down. So at this point, it's all about finding our entry on this M formation. So how do we find our entry on this formation? Well, the answer is very simple. You cannot find it from the weekly. You need to go on the 4-hour time frame. So let's go on the 4-hour time frame. Now, if you remember, and I hope you do, we had created a template for indicators. And also, we had already explained how market structure works. The market creates lower lows and lower highs in a downtrend. And in an uptrend, it creates higher highs and higher lows. And also another important concept is that if the market finds support around this area, when the market will break the area to the downside and go for a retest, this area will obviously become resistance and the market will continue the push to the downside. At least this is what we expect from the market. And again, it's the exact same concept if the market is in an uptrend. The market finds resistance, and this resistance, once it's broken to the upside, we expect it to become support and the market to continue the push. So previous support becomes resistance and previous resistance becomes support. A very key topic in the market and very simple concept. Now here, obviously, we don't have any kind of confirmation that the market will shift, basically shift its momentum to the upside. Now, if you remember, we used an indicator template. We created it and we called it AAA. Now, this is how you're supposed to use the indicator template. When you are on the 4-hour time frame, you're supposed to use the indicator template to understand in what kind of environment you are in, because you don't want to be looking for longs if you are in a bearish environment. Now, how do you understand if the market is in a bullish or bearish environment? First of all, by looking at price action. The market keeps printing lower lows and lower highs. But again, we need more confirmation in that price action alone is not enough when you are on intraday time frames. We need more confirmation where we are on intraday time frames, and we want more confidence. So to do this, we can use obviously environment indicators. And the 10 and 20 EMA and the MACD are exactly what we just said. They are environment indicators that tell you in which kind of environment you are trading in. If you are trading in a bullish environment or if you're trading in a bearish environment. Now, obviously, if you have an information, you want to wait for the market to be in a bullish environment before you are taking any kind of trades, because it doesn't make any sense to take a trade if you are in a bearish environment. If you want to take a long trade, it's very risky to take it. So let's keep on playing our replay tool. Now, one thing we didn't define is how to use the indicators to understand if we are in a bullish or bearish environment. How you're supposed to do it is very simple. If the 10 EMA, so in this case the red one, is below the 20 EMA, so the blue one, we are in a bearish environment. And also if the market is below these two EMAs, then the market is in a bearish environment. And the third thing you need to check about the EMAs is that there is distance between them. Now if there is distance between the EMAs, it means that the market has strong momentum to the downside. If the market is basically, if there is not much distance between the EMAs, like for example here, so they're very close, then it means that the market is basically has not much momentum. Then when the market starts impulsing with more momentum, that the EMAs obviously become wider and wider. So basically that are the three things you need to check when you're looking at the 10 and 20 EMA to see what kind of environment you're in. You need to check how far they are, and you need to check if the 10 EMA is below the 20 and if price is above or below. Now in this particular case, you have all three conditions to the downside. You have the market below the EMAs, you have the big separation between them, and you have the 10 below the 20. Now how you're supposed to use the MACD to understand direction is very simple. The blue line, if you double click on the MACD, you will get it at full screen. Now if you double click on this, you get the settings. If you go to inputs, you basically on style, sorry, you immediately see that the blue line is the MACD. Now what you're supposed to do is basically look if the blue line, which is the MACD, is below or above the zero. Now where is the zero? Let's go here on full screen so it will be easier to see. Now where is the zero? This is the zero, exactly here in the middle between when the histogram goes bullish or goes bearish. Exactly in the middle, that's the zero. And what you need to see is that if this blue line, let's use blue, if this blue line is above or below this level. If it is above, then the market is in a bullish environment. If the MACD, so this blue line, is below, then you are in a bearish environment. So if you want to take short, you need both the EMA's conditions to be to the downside and the MACD to be to the downside. And in this particular example, we have both to the downside. As you can see, you have everything bearish on the EMAs and everything bearish with the MACD. But that is the reason for which we use multi-time frame analysis, because we know from multi-time frame analysis that we have an information. And so an information will by definition complete when the market will go to the neckline. So what we are waiting here is for the situation to be completely the reverse. Basically, we're waiting for the market to be above the EMAs, the 10 EMA we want it above the 20, and the MACD we want it above the 0. At that point, we can be looking for price action entries, and we will get to that as soon as all of our conditions get satisfied to the upside, because at the moment taking long it's extremely risky because the market is still in a bearish environment. And as you can see, many traders took long here because obviously, let's bring it back to red, because obviously the market broke structure to the upside because you had previous resistance here, the market broke it to the upside and they expected the market to continue to the upside. But obviously the momentum, basically the environment they're trading in, is still a bearish environment, and that is why price action alone it's not enough. You need more confirmation when you're trading intraday time frames to time your entry. Now let's continue going and see what's going on. The market is still completely in a bearish environment. MACD is below the 0 and the market is below the EMAs. Now this is the first time that we got basically the situation to reverse. The MACD broke to the upside. As you can see here, we can double click on it and you can see that the blue line cut to the upside. And we can also see that the market is above the EMAs and it broke structure to the upside. This was the previous high. The market broke the structure to the upside. Now this is a very good confirmation that the market is now ready to go to our neckline. So what you're supposed to do is go back to the weekly time frame and identify your neckline. Now if you look, this was the neckline. Correct. Now as we said many times, the neckline, the real neckline, is actually the close on the weekly time frame. So what you're supposed to do, go to a line chart, take your horizontal ray and put it on the neckline. At that point you basically have your real neckline. Now what we know is that the market respects very strong numbers that are 20, 50 and 80, and our true target is the first strong number below the neckline. So if we know that 0.7172 is the neckline, the first strong number will be 0.7150. So our target will be 0.7150. Let's change it to 0.7150. This will be our target. This is where we are aiming for our take profit. Now, can we take long from here? That is the main question you're supposed to ask yourself. Can you just take long from this high? And the answer is obviously no, you cannot take long from here, because if you want to take long from here, anyway your stop loss needs to be way below. You don't really have your strong numbers, and you have an extremely shitty risk to reward, 1 to 1.7. So that is not obviously one of our entries. What is one of our entries? Exactly the same patterns we already spoke about. So previous support and resistance, W formations, and N formations. Everything extremely simple. Nothing changes. The only thing it changes is that you're using those patterns on lower time frames, in this case the 4-hour time frame, and you already know the direction because you use these exact same patterns on higher time frames. So you know the direction, you're just looking on how you're supposed to take your entry. And you're using environment indicators to understand when you're supposed to be looking for those entries, because the momentum of the market is on your side. Now in this case, everything is broken to the upside. Now what is our trick? We want to use our strong numbers. So let's look at the market. At the moment we are around the 80 area, but there is no structure around the 80 area. What is one of our valid entries? Previous resistance turned support, the patterns we already spoke about in the introduction section. The market goes to upside, downside, upside. Where is the previous resistance? If your answer is not here, then you didn't understand how the market works. The market creates higher highs and higher lows, and this will be resistance levels and this will be support levels. So if this support level here gets broken to the downside and goes for a retest, this previous support becomes resistance. And the same exact concept is what happens here, and happens all the time. The market created head resistance here. We're expecting this resistance to become support. So where will our entry be? It will be around this area, but we need to have a clear area, clear price in which we want to enter the market. And the answer to this comes extremely simply by just recalling that we use very strong numbers for our entry, 50, 20, and 80. And why we use those numbers? Because it basically high frequency trading firms use these numbers for their entry. So as you can see, this will be the area from which we will be interested in the long on this pair. So we want to take long from the 50. We want to have a safe take profit. Now, what will be a safe take profit? Sorry, we want to have a safe stop loss. The take profit, we already have it. So where will be a safe stop loss? The safe stop loss will be very simply. We know that we need to have a take profit that is below this box, because we know that the market can make a slippage all the way to 35. We already know that. The market can make a slippage all the way here. We expect the market to land somewhere inside of this area before starting the real push to the upside. So what we're supposed to do, our stop loss obviously needs to be below. Now if you want to be completely safe, the answer is very simple. Your take profit needs to be below the 78.6 of the Fibonacci of the impulse leg. In the case of in the case of a previous resistance turn support entry, or previous support turn resistance entry, is the exact same thing. So what do I mean by Fibonacci of the previous leg? The market started here, and we still don't know from where the market will start the push to this area. But when the market will start this push, we will take our Fibonacci on the impulse leg, we will put our limit order, and we will put our stop loss according to the Fibonacci of this impulse leg below the 78.6, and our entry, we already know it. So let's see when the market actually started the retracement. Okay, so now we have the first candle of the retracement, but you can see that the next candle kept impulsing to the upside, so you can't really take this short from this level. Okay, so now we know, we couldn't obviously take our Fibonacci from this level. We needed to see that the market was clearly starting the retracement to our level. So let's take at this point our Fibonacci from the low to the high. We already know our entry, that is at the 50. At this point, we can clearly see that our take profit is our stop loss is perfectly fine. Our entry, we already know that is around the 50. Basically, our stop loss, we already know that if we want to have a safe placement, we need to take our Fibonacci on the impulse leg, and our stop loss will be below the 78.6. And at this point, we are completely set. We can just take our put our limit order. I'm deleting the vertical lines because it seems we put them they're not relevant anymore because at the moment we are in the middle of the week. I just need them to check if we are at the beginning or at the end of the week, because obviously in the first hours that the market opens, I'm not interested in taking the trade. Or if the market is about to close, then I don't take trades. So if the market is in the middle of the week, then you don't really need the beginning of the end of the week. But you need to always check if you are if you're obviously backtesting a strategy, if you are just at the beginning of the week or just in the end. If you are in the middle, you don't really need to know where is the beginning or the end. So here we have our limit order set. This will be your trade. You just go to how I showed you on my Fارکس book position size calculator. You calculate your lot size, put your pending order, put your stop loss, put your take profit, and you're perfectly set. Now is the time to basically let the market do its job. Will the market just start a new impulse from here? Then we will be ready again to take an entry from here. Or will the market just hit our entry and then go to our take profit? Perfect. We will just let the market do its job. Or will the market just melt and go to our stop loss? Again, it is not a big deal. In the end, it's just a game of probabilities. Okay, so the market broke to the downside, went to our entry. Perfect. We are in the trade. We know that we have good probabilities on our side because we have made a multi-time frame analysis. We know that we are in a bullish environment. We have distance from the EMAs. We know that the market went to the high retracement, higher high. Market retests our strong area plus previous resistance, now turn support. MACD above the zero. Everything is bullish. So anytime buyers should get back into this market, unless obviously something weird happens in the world. We have fundamentals that come into play and the market will just keep the push to the downside, but buyers should get back inside of the market anytime. So we have the first push to the upside. Now you can see how accurate our area is. The market was stopped exactly by the 35, which is 15 pips below the 50, as I teach you, because the market loves to respect these areas. As you can see, it never broke below. You had a little bit of a slippage here, but the closes never broke below this area, and that is the important thing in the market. The closes are extremely important. So at the moment, the market is moving in our favor and everything is perfect. Now, this is exactly the moment in which you're supposed to go risk-free, because in this case you had impulse, retracement, the market started a new impulse. So basically, at this point, you can go risk-free, because if the market needs to push back down below, we have a low here. So if the market now pushes below, the market created a lower low. So basically, that is the exact moment in which you're supposed to go risk-free. Now, what do I mean by risk-free? Very simply, you take your stop loss and you move it 1 pip above your entry price, meaning you are covering the commission on the trade and you're not risking anything. If the market will go back here, it's exactly as if you had never taken the trade, because basically you're not risking not even $1. Now at this point, the market is supposed to continue the push to the upside to the neckline from a pattern perspective, because at this point we have a confirmed shift in momentum to the upside. We have our pattern. We know that the market is supposed to hit basically the neckline, because that is what the market loves to do. Let's see. Perfect. So in the end, the market did hit our neckline, and we banked a nice 1 to 3 risk to reward. Perfect. At this point, let's take away all the indicators. Let's just keep our trade and let's move to the next pattern. Let's go back to real-time chart, a real chart, and we have already tested the first entry around this area here. Let's just put a vertical line to remember it. We already tested this formation here. This nice information obviously completed. Now let's look at the next information that the market shows us. We have up, clear, down, up, down, clear information. So what you're supposed to do is, obviously, as we did before, take some vertical lines and put them on these weekly candles, so we know the start and the end of the weeks. That is the only reason for which you need them. Now, one thing you need to keep in mind when you look at this pattern: this is an information inside of an information. Now, what I mean by this, if you look closely, because this actually happens quite often, if you look closely, you have from here up, down, and then inside of here you have up, down, up, down. I will draw both of them separately. Up, down, up, down. You're expecting a push to this neckline. And on the other side, you have up, down, and you're expecting a push to this neckline. So you have an information inside of an information. Now in this case, obviously your take profit, you will take it at the first neckline, because you never know which of the two necklines the market will actually respect. So it's very important to say this. Now what you're supposed to do is obviously to go to the line chart, take your take profit price. You know where the neckline is. Now you need to read the price. It's 0.7488, meaning that our take profit will be at 0.7480. You already know the rules. We're supposed to put our take profit at the first strong number below the close of the neckline. So we have our take profit. Let's use the reply mode and let's delete this box. And actually we don't even need to mark the previous M, and let's go on the 4-hour time frame to see when the market will shift momentum. Let's go to templates, AAA, and we will have our indicators here on the 4-hour time frame. Now, as you can see, at the moment, momentum is extremely strong to the downside. Distance between EMAs is very big, and the MACD is absolutely below the zero. So at the moment, momentum is completely to the downside. We just have to wait and see a shift in momentum. The market broke above the EMAs, but as you can see, the MACD never shifted direction, never shifted. So this is why it's important to use the combination of the two, because if you hadn't, the market would have broken above. You would have seen the previous resistance here that has now become support, and you would have taken long, but in a bearish market. So basically not a smart move. Now this is the first time that we actually see that everything shifted to the upside. You basically realize that you have your MACD above the zero and market above the EMAs and the 10 above the 20. so everything is perfect. Now where should your entry be? Around this area, because as you can see, we had resistance here. You can also see this red candle, we had resistance here, and this resistance has now become support. And if you look at prices, you have 0.7420, slippage number of 20 is obviously 0.5, which is 15 pips below. So very simple to realize this. So your entry is supposed to be 20, your stop loss in this particular case can just be below the low, and your take profit is here at 80. Now in this particular case, you realize that you don't have a 1 to 3. So if I don't have a 1 to 3, generally I don't take the trade. That is the simple rule. If you don't have a 1 to 3, you don't take the trade. But let's see what happened. So our entry got hit exactly, and also take profit hit. Now generally I don't take these trades if I don't have 1 to 3. Keep in mind that win rate is quite high on these patterns, especially if you use all the rules of the strategy. So from a general perspective, I always say don't take the trade if you don't have 1 to 3, but overall if you have 1 to 2, especially 1 to 2.35, it's good to take the trade, but only if you are, for example, in a winning streak. If you are in a winning streak and everything is going great, then you can take also less than 1 to 3, but not less than 1 to 2. But overall, if you want to take this trade, that is the reason for which I played it anyway, is that you can take them if everything is doing great. If you're not in a winning streak at the moment, and if you're afraid to get a little bit emotional or something like that, it's always better to stick to the rules 100% and don't take trades if you don't have at least 1 to 3. Now keep going with our testing to show the rules of the WM strategy. Let's delete these lines that were just showing at the start, showing us the start and the end of the weeks, and let's move to the next pattern. So the next pattern is obviously this W formation here. Very simple W. Now this, if you remember, is a variation of the bearish W. We expected the market to push down from here, then but the momentum never shifted, and you can see this clearly on the 4 hours if you go down on the 4 hours. Now there is one thing I need to show you about this pattern, because we will not be looking for an entry on this pattern. This is why. If you look, if we now go to replay and we go on the daily time frame, and let's actually delete all indicators, you might be tempted to say that you were looking for an entry around this area. Now I know that this might seem true, but if you are so near to the neckline, extremely near to the neckline, you will never get not even a 1 to 2 risk to reward. So there is no reason to be looking for an entry if you are almost at the neckline. Plus you have daily structure, and one of the rules, if you remember, is you don't need to have daily structure. Where are the rules? You don't need to have daily structure, no daily structure. So basically you wouldn't be looking for an entry here. That is what I wanted to show you guys. You were not looking for an entry around this area. The reason for which we are on the daily time frame is because with this big pattern we are getting daily structure. The market is moving in waves also on the daily time frame. In the other cases we didn't have any kind of daily structure, but in this case we are getting daily structure. So we need to see when the structure is aligned with the pattern. What I mean by this, when the daily structure is also to the downside. At that point you can go on the 4 hours. But if you have bullish daily structure, so basically if now the market breaks this level as it did, we have previous resistance here that is now turned support here. So we can't go on the 4 hour time frame. Even if we get a valid entry in the 4 hours, we can't short the market to the neckline. Why we cannot short the market to the neckline? Because we have them, if we want to go to our take profit, we need to break this strong level of support. So it's not a good thing to risk money if we have to basically break this level, because we are basically trading against probabilities. So let's see when we will get a break of structure on the daily time frame to our side. As you can see, previous resistance turned support, respected very well. The market continues creating higher highs and higher lows. Everything is still bullish. Look, this level is still holding. Everything is bullish. Now this is the first time that the market breaks the level. As you can see, when the market created this red candle here, the structure was broken to the upside, to the downside. The market basically broke this trend line, in other words, this counter trend line to the downside, and the market is now in a bearish structure. Now, if you remember, where is basically what kind of pattern this is? If you remember, this is a clear exhaustion pattern. In other words, it is a rising wedge. As you can see, the market created a rising wedge, and when the market broke this counter trend line to the downside, why do I call it counter trend line? Counter trend line because if we know that the trend is to the downside, and we know that the trend is to the downside because we have a bearish pattern, because from the weekly we have our bearish W, variation of a bearish W. But anyways, the W formation. So what you need to know from a bearish W or W in general is that you're expecting a push at least to the neckline. So you're expecting a push to the neckline. So if you see a rising trend line, is it a trend line? Is it a counter trend line? Because it's meant to break at some point to the downside. So at this point, when also the second rule is satisfied, so basically when we have also when we have also no daily structure that is in between our entry and our take profit, we have our WRM formation, in this case a W formation. We only need our last rule to be satisfied to take our entry. We need 4 hour entry rules to be satisfied. So let's go on the 4 hour time frame and let's look if our 4 hour entry rules are satisfied. First thing, bring up your indicators. We need to see if momentum has shifted to the downside. So as you can see, as we are speaking with this market price, MACD is still above the zero. EMAs have already cut for short, but MACD is still above the zero, so we cannot short. MACD is still above the zero. MACD is still above the zero. Perfect. This is the first candle for which MACD breaks below the zero. You can see blue line is below the zero. Perfect. At this point, we can take short if we have one of our valid entries. And as you can see, we have it. Very simple. Break and retest of a trend line is one of our valid entries. Because we already spoke about trend lines, the market loves to respect trend lines, and if they are broken to the upside, the market will retest them and continue the push. On the other side, if you have, for example, bullish trend line, the market will respect it. At some point, the market will break it, retest it, and continue the push to the downside. Extremely simple concept, yet extremely useful and powerful. Now, one thing we didn't do, we did not determine where is our take profit from the weekly time frame. So let's go on the weekly and let's identify the neckline of this W formation. Now let's go on the line chart. Let's take our horizontal array. Let's look at price, and you realize that you have 52, but in other words, 52 is actually 80, because we need to take the first strong number above the neckline. So here will be our take profit. Now, one thing is in between our entry and our take profit, and basically it is this candle here. This is a structure candle because in all of this push to the upside, you can see that there is one candle that is not related to the move, so basically of a different color, and that will act as support, unfortunately. So we need to see what will happen when the market will hit this area. if we get a 1 to 3 risk to reward to here, then we can just put our take profit here. If we don't, then we can put our take profit at the neckline, because overall we still have our formation. So the market overall is supposed to reach the neckline of this W. Now let's go on the 4-hour time frame and see what we can do. Now at the moment we can also delete the EMAs and basically all the indicators, because we already know that they are aligned with us. So we don't need them anymore. It's just a quick check to see when the momentum has shifted to our side and when we can go back to price action to perfect our entry. Now in this case, entry is extremely simple. The market, they already cut for short, everything is bearish, the market already rejected the trend lines. We can just take our short and in an extremely simple and basically mechanical way, just put your take profit few pips above the high here. The market is not supposed to go all the way back to this high. The market is just supposed to shift to continue the push to the downside, because very simply we already know that we have a very good probability of completing the pattern and the market has already shifted its momentum to the downside. Overall, this would be a 1 to 4 risk to reward. Let's see what happens if we take our take profit around this area. Now, if we take our take profit inside of the area, or in other words, if we take our take profit at 0.7550, then we still have a 1 to 3. Overall, yes, from a very strictly rules perspective, we need to put our take profit here, the first strong number above the neckline of the M and W formations, but we have a good support around this area here. We had found it on the weekly time frame, so we can also go for a simple 1 to 3 to this area. Overall, let's just see what happens if the market stops around the area we found on the weekly, or if the pattern completes. Now, just at the beginning, we are getting a little bit of basically drawdown, but then the market starts the push, the real push to the downside, goes for a retest of the area. Now, if the market will shift it to the downside from here, then we can just go risk free. Okay, this is exactly the moment in which we go risk free. So our take profit, sorry, our stop loss goes 1 pip below the entry. Why? Because if now the market goes for a retracement, it's supposed to find resistance here, and it's never supposed to go and take us out risk free. If it does take us out risk free, it means the structure is broken to the upside and the market is supposed to continue the push to the upside. So momentum is quite strong, but at this point, personally, I would have got out of the trade. Now, why do I say this? Because I have 1 to 3 risk to reward already, and we already know that we have strong, basically weekly support around this area. But let's see what happens if we actually get stopped out break even, as I think, because this area is supposed to hold price from the weekly time frame, or if the market will break below it. Okay, the market broke below it, below the area, so overall it seems like the weekly pattern will complete itself in a perfect way. So this is again a proof that this pattern completes itself. We have a very high completion rate, and if we learn basically how to trade them, we will be perfectly fine in the market. Now in this particular case, our take profit missed by a few pips, but at this point, if the market, this is an important rule, if the market starts to break structure to the upside near your entry, near your take profit, basically what you're supposed to do is just exit the market. Why do I say this? For the simple reason for which the market found support here, broke to the down, you can see that clearly by this green candle, broke to the downside, but then again, boom, back above that level. And once the market breaks above the level, at that point, basically you just get out of the trade, because you have more than 1 to 3, almost 1 to 4 risk reward. you're ready. The pattern is basically completed, just few pips missing. The pattern is completed. The market will not hit your take profit because it broke structure back above. At this point, just get out of the trade and bank 1 to 3.72. Very simple. But it's a very good thing to see that the market respected the pattern even if you had some weekly support. Back to the weekly, and let's go with another example. I think that the concept is starting to get very clear. The way in which you're supposed to apply the strategy is getting very clear. So we already back tested this one. Let's speak about this W formation here. Okay, charts are clean. Let's speak about this W formation here. You have down, up, down, up. At this point, you're expecting a push to the neckline. Let's identify our neckline immediately. Go to the line chart, put it here on the close on the neckline. You have 55. You know that the first strong number above 55 is 80. This will be your target. Use the replay. You have your W formation, so rule number 1 satisfied. We have to check if there is no daily structure. Let's go on the daily time frame and see if we have daily structure. Now you immediately see that we do have daily structure, so we cannot short. What I mean by this, daily structure concept will be even more clear when you will watch the ICI strategy. But anyway, if now the market pushes to the downside, it will find support here. So if you will find daily support, you cannot take the long. It's the second rule of the strategy. If you have daily support, you cannot take short, sorry. If you have daily support, you cannot take short. Why? Because if the market will go back to this area, it will find very strong support. And this is the ICI strategy. So you cannot take short if you have daily structure. So we need to ignore this pattern unless we get a new break of structure around this area. And so at that point, we have basically a structure broken to the downside. So if now the market will go back here and it will show strong rejection to the downside, then we can consider an entry. But until that happens, we cannot go for an entry. As you can see, the market never showed us not even one red candle around here. So basically we cannot go on the 4 hours to search for an entry because overall structure was everything was bullish. So taking short would is basically mean taking a risk that was not worth it, because the market is supposed to stop on daily structure levels. So going back on the weekly, let's go to the next pattern. And then I think that the concept is quite clear and we can move to daily and weekly W formations with the next section. Again, the concept is quite clear. Look here, we have from this low, up, down, and formation, you're expecting a push to the upside. Also in this case, you have added confluence. Why do we have added confluence? Look left, resistance, 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 extremely strong resistance. This resistance is broken to the upside with this candle here. The market goes all the way up, goes down, and retests this extremely strong resistance that is now obviously extremely strong support. So an extremely strong resistance that becomes an extremely strong support. So obviously you're expecting a completion of the pattern. In this case, you have so high probabilities that the market will complete the pattern, extremely high probabilities. These patterns complete even in normal conditions. In this case, you have extremely high probabilities that the pattern will actually complete. Now, if we go on the 4-hour time frame, let's determine actually our take profit. Go on the line chart, put it on the neckline, look at the price, 0.7891. 0.7880. Simple concept. At that point, what you do, you go on the 4-hour time frame and see what kind of price action you are getting. Let's go on templates and let's test it. Everything is still bearish. That is the first time that you get a break to the upside. Now, once you get a break to the upside, you need to look left. Where is the previous basically resistance now turn support? And you can see that is here. We had resistance, and this resistance is now support. So what you need to do is take your box and check what kind of numbers you have. I realize that this line here is basically 0.7. Now 0.7, if you remember, is the slippage number for 50. So 20.05. So what you're supposed to do at this point is obviously put your pending order exactly on the high of this candle. Exactly here. What about your stop loss? You already had the first candle to the downside. So very simply, you take your Fibonacci from the low to the high, you know your take profit, and your stop loss, you already know it. You need to put it below the structure, below the 61.8, and possibly a couple of pips below the 78.6. In this case, your stop loss is way well protected by all these levels of structure, so you will be perfectly fine. If the market will hit your stop loss, it means that the pattern has failed. And that is exactly what you need. Your take profit needs to be at a level at which if it gets hit, then it means that the pattern has failed. So our entry got triggered perfectly. As we just said, we had a limit order exactly on the high of this candle, and the market starts to push to the upside. One thing I forgot to tell you, on this candle, that's the candle on which you go risk-free, basically, because if now the market goes for a retest, it will find support around this area. So at this point, you will be risk-free, and the market just went to take profit. So perfectly, you banked another 1, 2, 3. So I hope the concept is clear. If it isn't, you all have my WhatsApp. You can just send me a message and I can clear it up for you. Also, make sure you keep going with the sessions about the WM strategy, because I will keep publishing more and more. And this is all for weekly WM formations. And now you can go to the daily M and W formations, which basically have a couple of different rules.